Thank you for joining us today. We'll be getting started in just a few moments. We had a number of people registered and more people are still showing up, so just a few moments. Thank you for joining us today. We're getting starting in about one more minute, so bear with us. Just one more minute. People are still logging in. Okay, let's get this started. So thank you very much for joining us today. We'll be covering how to optimize credit scores to qualify for home financing. This is brought to you by the Housing Services Department. Our objective today is to provide you the tools and resources and information needed to optimize credit scores for the purposes of qualifying for a home loan at the best possible terms. Just a little housekeeping. If you take a look at the right-hand side, you should be able to see some links where you can download a PDF of the workbook that we're viewing today. And at the end of the slideshow presentation, you will be able to get a copy of the slides on the same right-hand column. We do wait till the end of the presentation to give the slides. Otherwise, people grab the slides and then end up having a ton of questions because they didn't stick to the actual presentation. So it's for your own benefit. I'm going to cover everything quickly. I'm not going to dwell on anything. Just going to move along quickly so that you can get the information you need in order to qualify for home financing. My name is Brian Diaz. I'm a nationally recognized credit expert, licensed mortgage professional, best-selling author on the topic of credit. I'm also a U.S. Army veteran, husband, and father. I've been in the financial industry for over 20 years, and this is my passion. I love helping people to realize their dreams of home ownership. Today, we're going to be covering the federal laws and regulations regarding credit, credit reports, credit scores, improving your scores, and an action plan that you can follow to see results relatively quickly. So the first thing we're going to cover is the federal regulations that cover credit and credit reporting. The number one pushback that we normally get is a lot of people are under the impression that you can't do anything about your credit scores, that the scores that we see are the result of your actions that you have or have not taken, and nothing can be done about that. Nothing could be further from the truth. An actual government accountability study performed a few years ago showed that 1 out of 5 credit reports contained errors which were no fault of the consumers, and those errors resulted in a credit score decrease of 50 points or more, which could have prevented a lot of people from obtaining approval for whatever credit application they were applying for. So errors happen all the time, and just the lack of education in general about how credit scores are formulated and what's on your credit report, that lack of information is keeping you from getting your scores as high as possible, which would save you money for the long term. So that's the purpose of this presentation like this. So the first regulation is the Fair Credit Reporting Act. Again, the first pushback that we usually get regarding improving credit scores is that there's nothing you can do about the information that appears on your credit scores, and that's actually not true. The Fair Credit Reporting Act is a federal law that regulates the collection of consumers' credit information and access to their credit reports. There's 3 main criteria that it really encompasses. CRA means credit reporting agency. There's three main credit reporting agencies: TransUnion, Experian, and Equifax. There's a lot of several smaller ones, but we don't concern ourselves with them. These are the ones that matter for the most part. Those credit reporting agencies have to have a reasonable procedure for gathering, maintaining, and distributing credit information. The second one is data furnishers have to have a reasonable procedure for ensuring the data they provide is accurate. A data furnisher is any corporation or person or company that provides information to the credit reporting agencies. So that could be your lender, your collection agency, even your employer if they sending them information. Lastly, the CRAs can only provide credit reports to people or businesses that have a valid reason to request a copy. This is what prevents anyone from collecting a credit report against, on any person that they choose. It has to have what's called a permissible purpose. The second regulation that you should be aware of is the Credit Repair Organizations Act. The Credit Repair Organizations Act is a consumer protection legislation that regulates companies that are offering credit repair services. And it really breaks down to 5 main criteria. First, a credit repair service cannot charge a fee before the work is completed. That doesn't mean that a credit repair service has to raise your credit scores over 100 points or 700 scores before they can charge you for the work. What it means is if you are paying a $100 fee for an initial audit, like a report that breaks down what's happening on your credit report, then they actually have to generate the report and provide it to you before they can charge you for it. If you are paying for the deletion of a particular item, let's say you have a collection on there and you're asking them to contact the collection agency and negotiate payment in exchange for deletion. Well, they can't charge you for that service until they actually obtain the letter of deletion or the agreement of deletion from the collection agency. At that point, they can charge you. The second item is that you can terminate a credit repair service contract for any reason within the first 4 business days. Some states will drop that to as little as 3 days, but federally, on for a nationwide scale, they all require at a minimum 4 business days for you to be able to cancel. A credit repair service cannot lie or exaggerate about the service. So when you see advertisements that they guarantee a 700 credit score or that they can delete 100% of your credit errors, that would be a lie or an exaggeration. This would be a violation of the Credit Repair Organizations Act. A credit repair service cannot lie to the credit bureaus or your creditors. One thing that is fairly popular is what's known as CPN numbers, where someone will charge you to set up a new identity for you under a new Social Security number, what's called a CPN number. CPN numbers themselves are legal. They are used by celebrities and politicians, basically people with high profiles, in order to create a new a new identity from the bank's point of view, so that when they make a purchase, they don't have to share that information with the public. So if I'm Kanye West and I don't want people to know that I'm buying this house, I'm going to use another identity that I've created in a CPN number in order to hide that purchase. But when the average person tries to use a CPN number to create a new identity in order to fool a lender that they had a poor credit history, that their credit scores are actually really low, that they're trying to create this new identity so that they can hide that information and not, that would otherwise keep them from getting approved, that would be a violation of the Credit Repair Organizations Act. You can't create a new identity. And lastly, a credit repair service cannot change or alter your identity. Another way to look at this is sometimes a credit repair service might contact your lenders that appear on your credit report, and they might say, have you file an identity theft affidavit? What they're doing is they're going to send that identity theft affidavit to every creditor on your credit report that's reporting negative data and claim that you never opened up that account. So this is one way that they can lie about who you are and what accounts that you've opened. So these are all violations of the Credit Repair Organizations Act and something to be wary of. All right, credit reports. So credit reports are different from credit scores. The credit report is a list of your account and payment information provided by your creditors to the 3 major credit bureaus: Experian, TransUnion, and Equifax. The credit scores are offered by a different company entirely. So we're talking about the information that appears on your credit report. That's what your credit report is. The information they collect is broken up into 4 different parts. First is the demographic data. That would be like your name, social security number, date of birth, employer name, phone, and address. The credit reporting agencies do not collect income information or medical information. So they don't know how much money you made last year, for example. Account trade lines. If you open up an account, a credit card with Chase, for example, or an auto loan with Capital One, that would be an account trade line. Credit inquiries. Every time you apply for credit, that will appear under the credit inquiries. So there's two forms of inquiries. There's hard inquiries and soft inquiries. When you apply for credit, like a loan or a credit card, that's a hard inquiry, and that can have an adverse effect on your credit score. A soft inquiry is when you go to something like Credit Karma to see your own credit report. That's reported, but it's not a negative because you're not applying for credit. You're looking at your own credit report. That's the difference. And finally, public records. Public records would be things like bankruptcies, tax liens, judgments. It's possible for the credit bureaus to show tax liens and judgments. At the moment of this presentation, they're only showing bankruptcies, but as of April of 2019, I believe, they stopped reporting tax liens and judgments, but just know that they can appear on there anytime in the future. So what appears on a credit report? So there's two different places that you can get your credit report that I would recommend. First would be annualcreditreport.com, which is a website which is set up by the FTC that allows consumers to download one free credit report from each credit bureau every year. It's fine. You're not going to get scores with it. They will try to upsell you to purchase scores, but the scores that they're upselling you to are not the kind of scores that lenders use. So I wouldn't recommend paying for them. These reports are fine. The only reason why I don't recommend them is simply because each credit reporting agency has a different format for their credit report, which can be confusing when you're trying to see what's going on in your credit report and how it's reporting and if it's accurate or not. Instead, the site that I recommend is myscoreiqreport.com. The company is actually myscoreiq.com, but we've worked out an agreement with them where they'll give you a 3-bureau credit report for $1. It's a 7-day trial. After that, it's like $27 a month, but you get your FICO scores. And it's my understanding this is the most inexpensive place to get your FICO scores online. And the information that appears there is really easy to read. Well, they actually provide us with a sample credit report so that I can help you understand how to read a credit report. You might find this beneficial. So this is sample information. This person doesn't exist. This is just like a John Doe type of situation. So this is what their credit report looks like. So over here is going to be the demographic information. This is the date the credit report was downloaded. The name of the person, Mary S. Cook. The date of birth would appear here. Then we have addresses. You can see that this Experian is showing a different current address than the other two bureaus. It shows the previous address with Experian as the other two bureaus. And then there's the employment information down here. As you can see, MyScoreIQ report.com offers FICO scores. Okay, so there's different versions of FICO scores depending on what it is you're applying for, which we'll cover later. But this is FICO score version 8. So you can see the scores here: 806, 787, 682. The scoring range is 300 to 850. It actually gives you the reason for the score here of what, if you click on these little things here, it'll give you a breakdown of each of what they mean by new account. So if you click on the buttons when you're on the active website itself. As you scroll down, you're going to have a summary of the account information appearing on the credit report. Again, this is just sample data. You can see the total accounts reported to TransUnion are 28, Experian 17, Equifax 16. This is not unusual. Even on a real credit report, it's not uncommon for a different number of total accounts, open accounts. All this information can be different from one credit bureau to the next. The reason for that is that not every creditor will report to all 3 credit bureaus. And it does often happen where they report different information from one credit bureau to the next. Now, this is actually a violation of your rights. It's not a good thing, right? But it does happen. But that's why the information can vary from one to the next. As we scroll down here, this is a sample mortgage account. So you can see the account number, the account type is mortgage, the detail is mortgage account. Bureau code, this is a joint account. Joint account means this account was opened with someone else as opposed to being an individual account or an authorized user account. An individual account would be an account opened by myself. I might open up a joint account with my wife or a business partner. An authorized user, perhaps my wife added me as an authorized user on her account. Under an authorized user account, I'm not legally liable for any of the debt on this credit for this account, but it does appear on my credit report. So you get the benefit of the credit history. This account status is open as opposed to closed. The monthly payment, date the account was opened, the current balance, the number of months or terms. So if this was like in many cases, this won't say monthly. This would only say monthly in terms of like a credit card because it's paid monthly. Generally, this would say like, let's say it was an auto, if it was a mortgage, it might be 360 months. So this might say 360 months, for example. High credit, that's the amount the account was open with. The credit limit, this is really only used with revolving credit cards, which I'll go into in a moment. If there's a past due balance here, payment status, this is paid or paying as agreed. If it was late in the past, it would say current was previously 30 days late. If it's currently late, it might say 30 days past due. Last reported is the last time this creditor reported to TransUnion. Any additional comments? If you had disputed this account, it would say, account's in dispute here. If the account was transferred recently, it might say transferred to another lender. Date last active is the last time any activity occurred for this account. So if they transferred it, it might be the date it was transferred. If no payments had been made in a while, then it might show the date of the last payment. And then finally, the date of last payment. So these two numbers could be the same if the last activity was the last payment you made. If you made a payment in 2/9, but in 3/9 it was transferred, then these two would differ. Let me jump to a revolving account. Okay, so revolving is the opposite of installment. Installment means you took out a fixed amount of money and you're paying it off in installments, as opposed to a credit card has a revolving balance. The balance can go up or down from one month to the next. Maybe you ran up a big balance on one month when they reported, and then you paid it off the next, and then you ran it up again, so the balance is going to change. So that's what revolving means. You can see this one's an individual account. Now, I was saying earlier that with credit cards, you have a limit. The difference is your credit card might have a limit of 10,000, but the most you ever borrowed against it was 4,328. That's what they mean by high credit. Sometimes your balance might exceed the credit limit. In other words, they approved some charges and allowed you to go over your credit limit. So that number would appear up here. That's why the two of them are different. All the rest of the information is basically the same. One thing I forgot to mention, the area down here gives you a visual representation of the last 2 years of your payment history. So you can see that when it says okay, that means the payment was on time. If it was 30 days late, it would probably say 30 or 60 or 90 based on the number of latenesses. So if you were late in November and December of 2018, it would say 30, 30, or if you made no payments whatsoever, it might say 30, 60, and then back to okay when you brought the account current again. So once we pass this account information, so these are your account trade lines. After the trade lines, we have inquiries, right? I think. There we go. Okay. So every time you apply for credit, whether it's a credit card or loan, that's going to appear under the inquiry section, which is this section here. So it says the creditor name, the type of business they're in. So this one, for example, Midland Credit is a collection agency. Wells Fargo is a lender. So they can say lender or services. Capital One Best Buy is a national credit card. The date of the inquiry and which credit bureau they pulled when they looked at your credit. So that's also listed here. On this particular credit report, it's only showing hard inquiries. So these are all could adversely affect your credit, and they stay on there for 2 years. Public information, if you had a bankruptcy, it would appear in this information in this area here. And then every lender that reported information on the credit report, their information's here, has their name, address, and phone number. So you can call them if you have a disagreement or have questions, or you can contact them by mail. We always recommend mail so that you can track your communications. All right, next, credit scores. Credit scores, well, okay, the best way I can explain this is all a credit score is a numerical representation of how likely you are as a borrower to fall behind 3 months or more. That's all they're trying to figure out. That's exactly what the number represents. The higher the number, the less likely you are of missing payments 3 months or more. The lower the number, the more likely you are to fall 3 months or more behind. So now there's a lot of different types of scoring models, but the two most common are FICO and Vantage. FICO is the scoring model created by the FICO Corporation. It used to be the Fair Isaacs Corporation. They created the scoring model first, and they're the ones who sell most of the scores to the banks that make the credit decisions. So if you apply for a credit card, a mortgage, or an auto loan, chances are the lender is looking at your FICO scores. And there's different FICO scores for mortgages, as for credit cards, as for auto loans. Vantage is the scoring model the credit bureaus created to compete against FICO. That's the credit score you see when you go to creditkarma.com or Credit Sesame. Most of the credit monitoring sites utilize Vantage scores. Both models, FICO and Vantage, use the same score range of 300 to 850. And while you might find that confusing, it was actually done on purpose. The credit bureaus sued FICO for the right to use the same score range. And the reason why they did that is because they had problems selling their credit scores to people through credit monitoring services, because people, they knew if the score was an A, B, or C, or if it was 1 to 10, they knew it wasn't a FICO score. It wasn't the same score as they were looking at with their lender. Once they started using the same score range, people didn't know the difference, and they were able to sell them. So you can see here the Vantage scoring model. They utilize five criteria, but you see how it's weighted in a different way, right? Like payment history is 40% of your score. FICO, regardless of the scoring model, of the version of FICO, it's basically the same criteria. 35% of your score is payment history, 30% is debt utilization, 15% is age of credit, 10% is mix of credit, and the last 10% is new inquiries. Okay, for the most part, I would only concern yourself with the FICO scoring model, because no lenders utilize Vantage score really for credit decisions. So one of the common questions I get is, why is it that people with a lower credit score, who obviously have less money to pay, why do they have to pay more? The reason behind that is that banks are in the business of making money. They got to turn a profit. So they lend money with the goal, with the intention of getting that money back plus interest. So when someone doesn't pay back their loan or their credit, they have to make up for that loss by charging other people more. So here is the odds. Here's the likelihood based on credit score of how likely someone is to fall behind 3 months or more. If your score is over 800, only 1 out of 1,292 are going to fall behind over 90 days. If your score is under 600, the chances are that 1 out of every 8 is going to fall behind more than 90 days. What that means is, if they're lending out money to people with 500 to 600 credit scores, and they know that 1 out of 8 is going to not pay it back, then they have to charge the other 7 more money in order to turn a profit. That's why people with lower credit scores have to pay more, because it's not fair for somebody with an 800 score who's never missed a payment to have to pay a higher amount when their risk is less. Right? That's the benefit of having a higher credit score, is because you're rewarded by having less interest payments. Oops. Another way to look at that is, if your score is 620, these rates are for educational purposes only. These rates do not exist. I'm just sharing to give you an idea of how this gives you how your credit score affects your monthly payment. So based on a loan of, let's say, $200,000 on a 30-year mortgage, if you had a 620 credit score, your interest rate might be 5.1. You'd pay $1173 a month. The total repayment to the bank would be $422,280. If your score, on the other hand, was an 800, your interest rate might be 3.51. Monthly payment is $972. You'd pay back $349,920. In short, you would save about $80,000 over the life of the loan by having a higher credit score. So even a small change, even just a small change of going from 639 to 640, you could conceivably save $70 a month. That's quite a significant savings, just by increasing your credit score 1 or 2 points, which is why the purpose of this presentation is to try to help you get to that next bracket. If a small change can have that much of an impact, then it's in your best interest to educate you to help you to reach that next threshold. So how do you go about improving your credit scores? Well, the first one is building credit, right? That's the obvious strategy. This is what we should be doing 90% of the time anyway. 35% of your score is your payment history. So that means pay your bills on time. As long as you're paying your bills on time, that's 35% of your score. 30% of your score is your debt utilization. Another way to look at debt utilization is if you look at the amount of credit you have available on your credit cards. Let's say you have $10,000 total credit limit, right? You have 2 credit cards, $5,000 each. You have $10,000 in available credit. How much of a balance are you carrying from one month to the next? If you're carrying $5,000, then you're at 50% debt utilization. You're using 5,000 of the 10,000 available. So by lowering that percentage, if you could get down from 50% down to 30% or 20% or 10%, the lower you lower that balance, that percentage, the higher your credit score will be. Okay, and if this doesn't concern installment loans, if you have auto loans or student loans, paying those off faster will not improve your credit score. This is more or less strictly on revolving credit. So credit cards are the only ones you have to concern yourself with. Get those balances down. Somehow along the way, someone started saying that 30% debt utilization was the correct percentage, the correct ratio. That's not correct. According to FICO, the optimal debt utilization percentage is 7%. Right? So they say 6 to 8%. So 7%. So you actually want to get your debt utilization under 10%. Sure, 30% is better than 50%, but 10% is better than 30%, right? So lower is better. So how do you lower your debt utilization? Well, obviously you can pay down or pay off your credit cards each month, right? Another way to do it is there's two factors in this formula. There's the credit limit and the credit balance. You can pay down the balance or you can increase the limit. So you can call your lender and ask them to increase your credit limit. That's another strategy to improve your debt utilization. I would only recommend calling and asking for a credit limit increase if you haven't missed any payments, if your credit cards aren't maxed out, and you haven't asked for one in at least 6 months. Another way to increase the amount of credit you have available is to add a new credit card. Right? Adding a new credit card is instantly going to increase your debt improve your debt utilization. I would add that you do not want to close credit card accounts, even if you're not using the credit card. Because if you have a card, let's say you have, 3 credit cards, $5,000 each. Actually, let's make it easier. So 4 credit cards, $5,000 each. So you have $20,000 in available credit. If your balance is $15,000, then you're at 75% debt utilization, right? You have $20,000 available, $15,000 balance. If you close one of those credit cards, now you only have $15,000 available and a $15,000 limit. You just dropped your debt utilization to 100%, from 75% to 100%, right? So you dropped your credit score as a result of increasing your overall debt utilization. So don't close your credit card accounts for that reason, okay? All right, so 15% of your credit score is the age of your credit. There's not much you can do about the age of your credit. You can have someone add you as an authorized user, like a parent, have one of your parents add you as an authorized user to one of their credit card accounts. That will artificially increase your age of credit. But you can also check to make sure that the date opened on your accounts on your credit report are reporting accurately, because they do make mistakes. The mix of credit, which means your ratio of credit cards to loans and the types of credit cards and loans that you have available, you want to keep it to about 1-to-1. So if you open up a student loan, it's okay to open up a credit card. If you open up an auto loan, it's okay to open up a credit card. But try to keep your mix of 1-to-1, and you want a variety. So if you opened up a revolving credit card, like a Capital One credit card, the next credit card you open might be a retail card for like Target or Home Depot, and then the next card that you open up might be like a fleet card that you use for gasoline only, right? So you want a variety of different cards, just like you want a variety of different loans. You have a student loan, you have an auto loan, you have a mortgage, you have a personal loan. You want a variety. Lastly is new inquiries. You want to limit the number of new credit inquiries, the hard credit inquiries, to no more than 2 every 6 months. After 2, you'll start adversely affecting your credit score. Okay, so the action plan. So the easiest way to improve your credit score is to to optimize the debt utilization portion of your credit score, right? Because your payment history to dispute negative items on your credit report, that's a long-term process. It's going to take you 30 days for every round of disputes, and it's very rare that they cooperate right away and start removing your negative stuff, even if you provide proof that they're reporting incorrectly. However, by changing your debt utilization, either increasing your credit limit or lowering your balances, then as soon as that new balance or new credit limit reports to the credit reports, that could be 2 weeks or 30 days, you instantly, almost instantly, as soon as it hits anyway, instantly, you get an improvement to your credit score. So this is a two-step process. The first thing I would do is add a personal loan with Self-Lender. Self-Lender is like a secured credit card, but instead of a credit card, it's a loan. You're opening up an account, let's say it's a $1,000 loan. Every month, you're going to make a $100 payment. At the end of 10 months, you have $1,000 in there. They give you the money back, less the interest and fees that they charge you for opening the account. But each month, they're reporting that loan to the credit bureaus. So you've just added a personal loan with a great payment history, and it reports to all 3 credit bureaus. The second thing I would do is as soon as that personal loan with Self-Lender hits your credit report, and that's usually like 30 days, the next thing I do is I would add $10,000 in revolving credit. Now, for many people who have just started to build their credit, or they already have a bunch of cards in it, but they're all maxed out, or they recently filed for bankruptcy and they're having trouble getting approved for cards, the first thing I hear is, Brian, there's no way anyone's going to give me a new credit card right now. I have relationships with 2 online retailers that will start you out with $5,000 each, provided you have at least 1 active account reporting to Experian. This is why another reason why I recommend doing the personal loan with Self-Lender first. They approve 99% of their applications. As long as you are not currently in bankruptcy, then you're fine, right? So these are online retailers, meaning when you get approved for these unsecured credit cards, you can't use the card to go buy gasoline. It has to be used at these particular retailers, but they will start you out with $5,000 each. If you utilize my links, they are also going to notify me if it looks like you're going to miss a payment and give me the opportunity to reach out to you to help make sure that you get your payment in so it doesn't adversely affect your credit while you're in the process of trying to purchase a home. So the links are here, but again, it'll be on the download so that you can go to those websites. You do have to pay an application fee, but that application fee is comparable to what you'd pay for a subprime lender like Credit One Bank, for example. Credit One Bank, if you apply for a credit card, they'll start you out with $300 and they're going to charge you $9 a month for the privilege of having that credit card. So you're spending $100 a year for a $300 limit. To me, to pay a $99 application fee to have a $5,000 credit card makes more sense. So each of them are going to charge you an application fee, but you're adding $10,000 in available credit. In my experience, my clients usually see a credit score improvement of anywhere from 20 to 40 points in about 30 days. The other thing you can do to improve your credit is work on the payment history, which is the other large aspect of your credit report. To repair credit, again, it is a process. You have to dispute the inaccurate late payments, collections, charge-offs, repos, or foreclosures, or public records which are on your credit report. To do this is a long-term process. Each step of that process is 30 to 45 days for the credit bureaus to investigate and respond. So you need to document every error that they've made. You have to find out what your rights are, and how they violated it in order to leverage those for deletions. It's too much for us to discuss in this conversation, but if you see errors reporting on your credit report, at the very least, sending out a dispute gives you some percentage chance of seeing a credit score improvement. I can tell you that one great strategy is if you happen to have collections on your credit report, you can offer payment in exchange for deletion, and most collection agencies will negotiate with you. What that means is when a collection agency acquires a debt, they're usually buying it for pennies on the dollar. So anything that they can collect over and above what they paid for it, that's their profit. So if you offer them payment in exchange for them removing it from your credit report, very often they're willing to make that deal with you. This can only happen with collection agencies. I've never seen any lender remove anything from your credit report in exchange for a payment, but collection agencies will play that game all day long. And it's not the balance on a collection that hurts you, it's the collection reporting itself. So just paying the collection, if they're not going to remove it, it's not going to help your credit score. It's still the right thing to do, but it's not going to improve your credit score. So if you can do that same thing and get the benefit of an increased credit score, why not ask for them to remove it in exchange for payment, right? And lastly, remove unauthorized credit inquiries. It's only 10% of your score, but you'd be surprised how often people look at their credit reports and see inquiries that they never made. So I would definitely take it under your make it a point to challenge any inquiries that appear on your credit report. It's a small percentage, but every little point, even 1 point, can help make a difference of you saving $70 a month in that previous example. So tips for success. First of all, you're going to want to sign up for credit monitoring and keep an eye on your credit report. I can't tell you how often someone comes to me for a home loan, and when we run their credit, they see items appearing on there that they had no idea about. And by the time they're applying for a mortgage, we really don't have enough time to remove those errors. So you want to stay on top of that, see the errors as they occur, and start disputing them or negotiating with them right away. I don't recommend disputing online if you can avoid it. When you dispute online, the credit bureaus are only required to perform 2 investigations every year, unless you provide additional data. When you dispute online, you're typically selecting your dispute from a drop-down box that gives you maybe 4 or 5 different options. So you are limited. You can't tell a story. You can't provide more information with that online dispute. So you're really limiting your probability of success. Before you start disputing, when you get a copy of your credit report, you grab a highlighter and make a list of, highlight all the items that you want to dispute. Do your research first and figure out what it is, what strategies you have in order to get these items off. To just start saying things, I was never late on this particular date, that's only going to get you so far, a very small percentage of success. But if you can prove that they're reporting information incorrectly on your credit report, and you can document that, and that's one of many strategies to use. If you can find those violations, well, then you can leverage those for deletion. So do your research first and find out what's the best way to attack it. Regardless of what you do, keep copies of everything. Keep copies of every dispute letter you send, every response you receive. What I do is I will email those items to myself, and I keep a file called disputes in my Gmail account. So when I email myself, I just stick it in that folder, so it's always there for me. Be persistent, because it's very rare that the creditors will give in with the very first round of disputing. You have to stay on top of it, and it's going to be at a bare minimum 3 to 6 months for you to see decent results. If you decide to work with any kind of credit repair service, don't pay any upfront fees for services. Make sure that they're adhering to the Credit Repair Organizations Act. Avoid any service that offers credit sweeps or clean sweeps, because basically all they're doing is they're charging you anywhere from $400 to $3,000 to complete an identity theft affidavit, and they're just going to contact all the creditors and falsely claim that you are saying that you never opened up those accounts, and you can get into a lot of trouble. And lastly, as we discussed, avoid CPN numbers unless you happen to be a celebrity or a high-profile politician. If you need more personalized assistance, you have errors on your credit report and you need assistance removing them, this is something that there's no harm in asking for assistance. I've made arrangements for you for a free consultation with a certified credit professional. Just call the number that appears on your screen. There's no cost. They'll help you obtain a credit report. They'll go over with you, explain to you what's wrong with the credit report and what steps you need to take to fix it. And if it's something that they can help with, they'll give you an estimate to handle it for you. At the very least, you'll have some clarity on what it is you need to do in order to get your scores to the level you need to be to qualify for your financing. Thank you so much for joining me today. I hope you found this information valuable, and I look forward to, I hope I played a part in helping you to reach your goals of home ownership.